What if I told you that banks make billions of dollars every year using this simple trick, and most people don't even realize it? In this video, I'll explain how credit cards actually work, the system banks use behind the scenes in the simplest way possible. No confusing terms, no financial advice, just facts that can save you thousands of dollars. What credit cards really are. At the most basic level, a credit card is not extra money. It's a short-term loan. When you swipe a credit card, the bank pays the store for you. You're not spending your money. You're spending the bank's money, with a promise to pay it back later. That's it. No mystery. The credit card company temporarily covers the cost, and you repay them after your statement closes. Now here's why this matters. Because the money isn't leaving your bank account immediately, your brain feels less pain compared to paying with cash or debit. This psychological gap is one of the most important parts of the system. Why millions of people use credit cards daily. Credit cards are everywhere because they're fast, convenient, accepted globally, built into online payments, subscriptions, and travel. For many people, credit cards feel like a normal part of life. Groceries, gas, streaming services, emergencies. And on the surface, they seem harmless. Swipe, tap, done. But the system isn't built around convenience alone. It's built around human behavior. Banks don't rely on everyone making mistakes. They rely on enough people making small, predictable ones. Here's how one full cycle works. You spend using the card. The month ends. This creates a statement balance. You're given a due date to pay. If you pay everything, no interest. If you don't, the system activates. That system is where banks make their real money. And most people don't fully understand what happens after step 4, how banks make money. The business model behind credit cards. Banks don't issue credit cards out of generosity. They do it because credit cards are one of the most profitable financial products in the world. They make money in 4 main ways. 1. Interest. The big one. Interest is the cost of borrowing money. If you don't pay the full balance, the remaining amount starts growing, daily. Even a small, unpaid balance can quietly expand over time. This isn't accidental. Interest rates are designed to be high, compounding easy-to-ignore short-term hem. The longer the balance stays unpaid, the more profitable it becomes. From the bank's perspective, someone who carries a balance is not a problem. They're a valuable customer. Number 2, fees, the silent earnings. Fees don't get as much attention, but they add up fast. Examples include late payment fees, annual fees, over-limit fees, foreign transaction fees. Each fee may seem small on its own, but across millions of users, they generate massive revenue. And here's the key detail. Most fees come from minor slips, not major financial disasters. One missed date, one overlooked charge, one automatic payment that didn't go through. The system isn't built for perfection. It's built for probability. Number 3, merchant fees. Invisible to you. Every time you use a credit card, the store pays the bank a small percentage. You don't see this fee directly. It's built into prices. This means banks earn money even when you pay your balance in full. So no matter how you use the card, the bank stays profitable. 4. Penalties and risk pricing. Credit card systems are structured around risk. If someone is seen as riskier, they're charged more. Higher interest rates, lower limits, stricter penalties. This isn't personal, it's mathematical. The system constantly evaluates behavior and adjusts the cost of borrowing accordingly. Why the system works so well? The credit card system succeeds because it combines psychology, spending feels easier; timing, payment is delayed; complexity, terms are rarely read; automation, interest runs quietly in the background. Most people don't lose money because they're irresponsible. They lose money because they don't see the full system. They see the swipe, not the structure behind it. The key awareness point: credit cards are not good or bad. They are tools. But they are tools designed by institutions whose goal is profit, not protection. Understanding that changes how you view every statement, balance, and payment. And this awareness is the foundation for everything else. Where people quietly lose the most money. By now, you understand the system itself. So now let's talk about how people unintentionally trigger the most expensive parts of that system. These aren't extreme mistakes. They're normal. They're common. And that's exactly why they're so profitable. Mistake number 1, paying only the minimum balance. On every credit card statement, there's a number called the minimum payment. It looks small, it feels manageable. And that's the problem. When you pay only the minimum, most of your payment goes to interest. Very little goes to the actual balance. The remaining amount keeps growing. This creates a loop where the balance barely moves, even though payments are being made every month. From the outside, it feels responsible. I paid what they asked. From the system's perspective, this is ideal behavior. The balance stays active. Interest keeps running. Time works in the bank's favor. Most people don't realize how long minimum payments stretch debt, sometimes for years. Mistake number 2, missing due dates, even once. Missing a due date doesn't feel like a big deal. Life happens, people forget, payments fail, but the system reacts immediately. A single missed payment can trigger late fees, interest charges, potential changes to how your account is treated. What's important here isn't punishment, it's pattern recognition. Credit systems track consistency. One missed payment isn't catastrophic, but repeated small slips quietly change how the system prices your risk. And once that pricing changes, everything becomes more expensive without any dramatic warning. Mistake number 3, applying for multiple cards too quickly. Many people think more cards means more flexibility. But when applications happen close together, the system reads it differently. It can signal increased reliance on credit, short-term financial pressure, higher perceived risk. Each application leaves a footprint. Individually, they seem harmless. Together, they start telling a story. And credit systems don't look at intentions, they look at patterns. Mistake number 4, using too much of the available limit. Here's something many people don't realize. It's not just whether you pay, it's how much of your limit you're using. If someone consistently uses a large portion of their available credit, the system interprets that as dependency, even if payments are on time. Again, this isn't emotional or moral, it's mathematical. The system isn't asking, is this person good or bad? It's asking, how risky is this behavior over time? Mistake number 5, not understanding credit score movement. Most people treat their credit score like a mystery number. They check it occasionally, they react when it drops, they celebrate when it rises, but they don't always know why it changes. Small actions can cause movement: timing of payments, frequency of borrowing, length of credit history, balance fluctuations. Without understanding these inputs, people accidentally damage their score while thinking they're being responsible. And the system doesn't explain itself when this happens. It simply adjusts the cost of borrowing. The pattern behind all these mistakes. Here's the key insight. Most credit card losses don't come from reckless behavior. They come from incomplete understanding. People follow what feels reasonable, pay something, use the card when needed, trust the system to be fair, but the system doesn't reward feelings. It responds to structure and data. And when people don't see that structure, they unknowingly play the game on hard mode. Why awareness matters more than panic. This part isn't about fear, it's about clarity. Credit cards don't trap people overnight. They work slowly. Tiny decisions repeated over time produce big financial outcomes. And once you see how these mistakes fit into the larger system, the entire picture changes. How people who understand the system think differently. At this point, something important should be clear. Smart people don't avoid credit. They control it. They don't see credit cards as free money. They see them as structured tools inside a larger system. And instead of reacting emotionally, they operate intentionally. The key mindset shift. Most people think like consumers. Banks think like system designers. Smart users learn to think the way the system thinks. That means understanding. Timing matters. Consistency matters. Patterns matter more than one-time actions. This mindset alone changes outcomes without doing anything extreme. Control over emotion. Credit cards are designed to feel easy. That's not a flaw. It's a feature. Smart behavior starts with recognizing that ease can blur awareness. Instead of asking, can I afford this right now? The smarter question becomes, how does this interact with the system over time? This removes emotion and replaces it with structure. Systems beat willpower. Willpower fades. Systems don't. People who manage credit well don't rely on discipline alone. They rely on repeatable habits, predictable payment behavior, consistent awareness of balances, intentional usage, not reactive usage. This isn't about perfection, it's about reducing randomness, and the system rewards predictability. Why knowledge is the real advantage. Credit cards don't punish ignorance aggressively. They profit from it quietly. The moment someone understands how interest accumulates, how fees are triggered, how behavior is evaluated, they stop being surprised by outcomes. And once surprises disappear, control increases. This is how the power balance shifts, not through avoidance, but through understanding. Credit is a mirror, not a villain. Credit cards don't force behavior. They reflect it. They magnify habits over time. That's why two people can use the same product and experience completely different results. The difference isn't income, it's awareness. If this video helped you see credit cards differently, that's the win. Understanding money isn't about fear, it's about clarity. Because once you understand the system, you stop reacting to it and start navigating it intentionally. If you found this breakdown useful, consider liking the video and subscribing for more clear, system-level explanations about money. Not hype, not shortcuts, just understanding. Because money is easier to manage once you see how it really works.